Yeah, once again, good evening. Please, just 1 minute. Let me take this. All right, please, can you mute? Can you mute, please? Deborah, please mute. Robbie, please mute. All right. By way of introduction, my name is Asiwaju Dayo Bello. Of course, students call me Asiwaju precisely. I will be taking some aspect of strategic financial management. I'm aware the class has started on Tuesday with cost of capital. Tonight, precisely, we shall be looking at two related topics. The first one is corporate failure. The second is capital reconstruction. This might take us like 3 lectures. Corporate failure. Before going to the topic proper, it is not impossible that Adejunwa has done an introduction to strategic financial management. But let me take like 10 minutes to do an overview of the expectation as regards strategic financial management. Let me also say that the impression created around this subject. Oh, please. Techno C cases. Please, can you mute? You are conflicting the class. Gloria, please, can you mute? All right, thank you. Now, the impression created around financial management is that this subject is perhaps the toughest at this level. I don't subscribe to that impression. No doubt, strategic financial management is very wide. And it involves a lot of computation. However, it is possible for students to write this exam and pass at one sitting. It calls for sacrifice. At every point in time, you must be asking yourself, what value are you adding to your preparation? At every day, you must ask yourself, the exam is coming up in November. November is not far. You must draw a plan on how you are going to address that exam come November. Now back to the business. What is financial management really? If you are to define financial management, you can define financial management as an integral part of management that is concerned with how companies source finance and how companies utilize finance in order to achieve the objective of the organization. I'm going to repeat that. Financial management can be defined as an integral part of management. It's an integral part of company's management that is concerned with how companies source finance. Company will source finance, and how company utilize finance so as to achieve the objective of a business entity. Look at that definition. Students, you must understand the different finance sources available to the business. That means we are going to look at finance sources. If you check past question, diet in, diet out, I can always take at least 20 marks question from sources of finance. This is because finance success is an integral part of financial management. Then, how company utilize finance so as to achieve the objective of a business organization. Company must source finance. Then company will utilize finance to achieve in such a way as to achieve the objective of a business entity. Now the question is, what is the objective of a business entity? The next question I will ask myself, what is the objective of a business entity? It is unanimously agreed that the primary objective of a business entity is to maximize the wealth of the owners. Let me restate that point. It is unanimously agreed that the primary objective of a business entity is to maximize the wealth of the owners. I can also ask myself, who are the owners of the business? The owners of the business are referred to as the shareholders. Hence, company to maximize the wealth of the shareholders. We can refine that objective. We can refine that objective by saying the objective of a business entity is to maximize the wealth of the shareholders without compromising the interests of other stakeholders. We can refine the objective by saying that the objective of a business entity is to maximize the wealth of the shareholders without compromising the interest of other stakeholders. Please note, there are several stakeholders to the business. regardless of your company. You have the stakeholders. The first stakeholder or the major stakeholders are the owners of the business. Then we have other stakeholders like the employees. Please hold on. Before we go to that, please ask yourself, who is a stakeholder? I'm trying to do an overview of strategic financial management to you. Who is a stakeholder really? Please note, a stakeholder can be defined as any person or entity that is affected by the action or inaction of an organization. I will try to repeat that point. A stakeholder can be defined as any person or entity that is affected by the action or inaction of the organization. Once the company action will affect that person, then that person becomes a stakeholder. For example, the employees. Where you work, you are a stakeholder in that company because the action of the company can affect you. You expect your salaries from the company. You also expect job security. You expect advancement in your career while you work in that company. That means action taken by the company can affect you. Then you become a stakeholder. The employees is a stakeholder. Number two, the suppliers to the company. When you supply a company, then you become a stakeholder to that company. Whatever affects the company can affect your supply and your funds. That means action taken by the company. The company must take cognizance of you as a stakeholder. While the company pursue wealth maximization objective, company must be conscious of the fact that there are other stakeholders whose interests should not be compromised. Again, you have governments. The tax authority is a stakeholder in every company. Companies have a responsibility to pay tax. And you must pay the appropriate tax, all things being equal. That means your action can affect tax payments. In other words, it can affect governments. Also, please note, the environment where you operate is a stakeholder. You must conduct your business in such a way as to keep the environment safe, not only for the present generation, but also for the future generation. The environment is a stakeholder in the business. when conducting our business, we must be conscious of the environment where we operate. We must keep the environment safe, not only for us currently in existence, but for the future generation. I haven't explained this. I'm going to go to the first topic I'm taking tonight. Please, if I'm becoming too fast, you might call my attention to it. If there's any concern, please don't keep quiet. The intent is to enhance understanding with a view to be able to pass your exam. No. Sorry, please. Like I mentioned, the objective of a business entity is to maximize the wealth of the owner. Now, what is corporate failure? That's my topic number one. A situation where a company cannot consistently meet its primary objective, that becomes corporate failure. Let me repeat that point. We explained that company exists in order to maximize profits, in order to maximize the wealth of the shareholders. Corporate failure is a situation where a company cannot consistently meet its corporate objective. Corporate failure is a situation where a company or a business entity cannot consistently make sufficient profits to meet the expectation of the business owner. If such situation remain unchecked, the company may eventually collapse. Look at the case of Diamond Bank. The bank experienced corporate failure. Along the line, the bank cannot survive it. Diamond Bank was absorbed by Access Bank. What could have happened? This is of interest to us as an accountant or as accountants. While we company that is established to make profits, and the company has been making profit for several years, all of a sudden, the company starts reporting losses. Where such situation is not checkmated, the company will eventually collapse. Please note, corporate failure is a situation where a company cannot consistently achieve a satisfactory return to meet the expectation of the business owners. Please, consistently. It is not sufficient to say we make profits last year. a company must consistently return profits because the company is established to make profits. It's like saying equity professionals. We are in the business of lecturing and imparting knowledge. Our goal is to be able to place the students in a position to be able to write that exam at one sitting. It is not sufficient to say we produce the best students last year, November. It's not sufficient. November 2023, we produced the overall best students. It is not sufficient to say we produce the best student in 2023. November 9th. We must consistently be producing best students. We must consistently be returning student passes. It's not sufficient to say our company, we are doing well last year. It doesn't make sense. We must consistently be driving the business to higher level. At any point in time that a company cannot consistently meet its corporate objective, then corporate failure has set in. Now, if a company experiences financial distress, corporate failure will follow. Unless the problem is identified quickly and corrected. What is financial distress? What are the causes of financial distress? Please, a slight digression. Some of us might be taking case study. Please, a slight digression. Some of us might be taking case study. This topic will still be discussed under case study. We are going to demonstrate practical, I will say, a real life situation on how to salvage company experiencing corporate failure. When we get to case study class, I'll be taking part of the lecture and case study too. All right. What am I trying to stress? If you're also taking SFM and you are taking case study, this topic is going to help your case study. Let's look at causes of financial distress. May we not be distressed financially. Number one cause, revenue failure. Revenue failure can lead to financial distress. Revenue failure may occur through loss of sales, loss of sales order. We call it market failure. Customers are not patronizing your products. That's a major problem. Where customers are not patronizing your products, that is market failure. or the acceptance of business that contributes nothing to the growth of shareholders' value. You are undertaking business or businesses, and you are not generating value or profits to increase the shareholders' wealth. Revenue failure will set in. Where there's revenue failure, this will give rise to financial distress. It is logical. You are not making sales. You have opened a business point, and customers are not patronizing your business point. That means you are not generating revenue. That will give rise to what? Financial distress. Financial distress will give rise to what? Corporate failure. Corporate failure, if not checkmated, will lead to the company liquidation or eventual collapse. Why are we discussing this? To open our eyes to likely causes of financial distress. Number 2 points, cost failure. Please. Cost failure. This may occur as a result of weak cost control. When you operate a weak cost control, inappropriate accounting policy, or when you are running your business at exceptionally higher cost. This can give rise to cost failure. You are operating your business at higher operational cost. If you don't watch it, the higher cost will reduce your profit. Reduction in profit will reduce the shareholders' value. And this could lead to financial distress. Number 3 points, failure in asset management. Number 3 points, failure in asset management. This includes failure to invest in appropriate technology. Company must invest in appropriate technological assets in order to be relevant in the business environment. Imagine banks. Look at banking in Nigeria now. Banking is largely driven by technology. A lot of times, we don't even go to the banking hall again. You can do transfer on your phone. You can withdraw at POS points without going to the bank. You can make payments online. That means in this current time, bank must invest in appropriate technology in order to be able to compete favorably within the industry. Failure to invest in could give rise to financial distress. Also, poor working capital management. It is the duty of the finance manager to manage the working capital of the business. That is, you must manage your current assets, your inventory management, trade receivable management, your cash management. As a finance person, you must manage your trade payables. Poor management of these components could lead to failure in asset management, which could give rise to financial distress. Where there's financial distress, the company may experience corporate failure. Number 4, failure in liability management. This includes the inability to manage companies' relationship with the money markets. This includes the inability to manage company relationship with the money markets. We can pause and ask a question. What is money market? You know, if you are reading, you must probe that reading too. You must question that textbook you're also asking yourself. This statement says failure to manage companies' relationship with money markets. I will now ask myself, what is money markets? A money market is a market for short-term borrowing and lending. Every company will access money market. At times, you want to borrow on short-term basis. At times, you want to place investment on short-term basis. It is to maintain a cordial relationship with the money market. Money market is where the commercial bank operates. If you are a company, you must maintain cordial relationship with your bankers. You might require their help. At times, you need to source funds fast. On short-term basis, you approach the money market. The inability to manage that relationship will lead to failure in liability management. Also, poor interest rate risk management. Poor interest rate risk management will also give rise to failure in liability management. Definitely, companies borrow money. As your business grows, you might need to support your business with borrowing to finance expansion. Once you borrow, interest rates will apply. Now, that interest rate will create risk. That could create financial risk for the business. If you don't manage that risk very well, that could give rise to failure in liability management. A company must pay the interest as at when due. Where a company fails to pay the interest as at when due, the bank or the lender can take action that can affect the life of the business. That means, as a finance manager, please, at every point in time, imagine yourself as the finance manager. If you cannot dream it, you cannot hold it. As a finance manager or as a finance director, you must maintain cordial relationship with the money markets, because your company might need to access the money markets. And in most cases, borrowing is always influenced by relationship. Number 5, failure in capital management. This could be as a result of over or undercapitalization. What is overcapitalization? What is undercapitalization? Company must maintain adequate capital base. You must avoid overcapitalization or undercapitalization. Overcapitalization, where you introduce too much capital to the business than required. You are killing the business. You are putting too much money to the business than the business requires. You'll be incurring loss. Don't forget, capital comes with a cost. Cost of capital. The topic you guys treated or you started on Monday. Capital is the resources, usually the finance resources used in the business. This comes with a cost. So if you push too much capital to the business, that means you are carrying too much cost. That will affect your income than required. Again, undercapitalization. You are not supporting your business with adequate capital. That's an issue to the business. That will affect the business running. This could give rise to financial distress. Also, poor management of companies' relationship with the capital markets. Poor management relationship with the money markets. Particularly the company's debt profile. That could be detrimental to the health of the business. Again, you can ask ourselves, what is capital markets? Now we define money markets. What is capital markets? Capital markets, a market for long-term funds. Capital markets, a market for long-term borrowing and lending. All right, we have discussed what is corporate failure. We have discussed likely causes of corporate failure. Any question, please? Today's topic is 100% theory. Any question, please? All right. Our next discussion. Corporate failure prediction. Corporate failure prediction model. Excuse me, please. Corporate failure prediction models. Yeah. Corporate failure prediction is concerned with trying to identify companies that are at the risk of corporate failure before the failure actually happens. Corporate failure prediction models. These are models that attempted to identify companies at the risk of corporate failure, so that management can take remedial action or corrective action before the company collapses. This is of interest to us as finance professionals. We can use this model. We can use the corporate failure prediction model to identify companies at the risk of corporate failure. Once we are able to identify companies at the risk of corporate failure, we can take actions so as to prevent the company from eventual collapse. There are two corporate failure prediction models. There are two corporate failure prediction models. The first is quantitative corporate failure prediction model. Quantitative, look at it. Quantitative corporate failure prediction model. And the second is qualitative corporate failure prediction model. Please note, there are two models. Corporate failure prediction model. We have the quantitative, otherwise known as the financial model. And we have the qualitative, otherwise known as the non-financial model. Let us explain the first one. The quantitative corporate failure prediction model assumes that company fails because of financial problems. Hello? I want that point to sink. The quantitative corporate failure prediction model assumes that company fails because of financial problems. Hence, we can use financial ratio to predict companies at the risk of corporate failure. Deliberately, I'm trying to reduce the pace. We are discussing quantitative corporate failure prediction. This school of thought assumes that companies fail because of financial problems. The model assumes that financial problems are the causes of corporate failure. The quantitative corporate failure prediction model assumes that the causes of corporate failure is because the company has financial crisis or financial problem. Hence, we can use financial ratios to predict companies at the risk of corporate failure. Do you agree with this position? Do you agree with this school of thoughts? You know, it's a model. It is subject to challenge. You can challenge the model. That companies face because the company is experiencing financial problems. Excuse me, please. A notable model under the quantitative corporate failure prediction model is the Z-score. A notable model under quantitative corporate failure prediction model is the Z-score. This model, the Z-score model, uses, or let me put it this way. The Z-score model is a financial model that uses 5 key financial ratios to predict company at the risk of corporate failure. The Z-score model, please note also, although this class is recorded and the video will be provided, it won't be too much. If you have any points you want to take down, what you take with your hand, stick faster. From experience, anyway. What you write down, stick faster to the body. All right, back to my discussion. The Z-score model is a financial model that uses 5 key financial ratios to predict companies at the risk of corporate failure. This model is represented by the equation highlighted on our screen. Look at it, please. Your Z-score. Please, you might need to memorize this. This is stated in ICANN Study Pack. You might need to memorize it. The Z-score is calculated with the equation 0.012 x subscript 1 plus 0.014 x2 plus 0.33 x3 plus 0.06 x4 plus 1.0 x5. How this weight is generated, we don't know. And we are less bothered. The owner of the model has developed the model. Within this, we are not expected to determine how this model come about, or this set of weights. What the examiner requires to know is how to use this model to calculate and determine company at the risk of corporate failure. Now, your X1, X subscript 1, let me increase it a bit. X1 is equal to working capital divided by total assets. X2 is equal to retained earnings divided by total assets. X3 is equal to profit before interest and tax divided by the total assets. X4 is equal to market value of equity divided by the book value of total debts. X5 is equal to 6 divided by total assets. Now, assuming you are giving financial statements and you are required to use Z-score, right? Assuming you are giving financial statement, company financial statement, and you are required to use Z-score model to assess if that company is at a risk of corporate failure or not. You are going to state the formula. You now go to that financial statement you are giving. Determine the working capital. Your working capital is current assets less current liability. Get your working capital. Pick your total assets and get the ratio for X1. When you get the ratio, you now bring it here. That becomes 0.012 multiplied by the ratio you derive here. You keep it plus. Now, go to the financial statement. Pick your retained earnings. Divide it by the total assets. You are going to get a figure. Bring it here, times. Next, go to the financial statement. Pick the profits before interest and tax. That is the operating profits. Divide it by the total assets. Introduce the value you have here. Again, get the market value of equity. What is market value of equity? How do we compute market value of equity? Somebody was trying to talk, are we? No. Yes, iPhone. Are you trying to say something, please?
No.
Okay. You can mute. Market value of equity is calculated as number of ordinary shares multiplied by the market price per share. So you are going to get the market value of equity. Then book value of total debt. The book value of debt is the balance sheet value in your financial statement. Look for the debt and pick it. When you get your figure, introduce it here. That will come here. Then X5. Your sales, your revenue divided by total assets. The figure you derive here, introduce it here. Then now compute your Z-score. How do you determine that the company is at a risk or not at a risk of corporate failure? How are you going to know if that company is at a risk of corporate failure or is not at a risk of corporate failure? Look at the guidance. With this model, Altman predicted that, look at this, where the Z-score is equal to 2.7 and above, where your Z-score is equal to 2.7 and above, this indicates that the company is not at any risk of corporate failure. When you compute your Z-score and you have 2.7 and above, this implies that that company is not at a risk of corporate failure. That is what the owner of the model says. And this is being used. Also, please note, some of us taking case study. You know, case studies is examiner will create a true life situation, and you are going to do a report. This might involve financial analysis. It might involve business reconstruction or business reorganization. This might come to play. I'm trying to also tell you that, please, this knowledge is not limited to SFN. Again, number 2, if your Z-score is below 1.8, it's an indication that the company is at higher risk of corporate failure. Lastly, if you compute your Z-score and you have between 1.8 and 2.7. This is regarded as gray area. This is regarded as gray area. It implies that there's possibility of failure, but the company is not at higher risk. Please, you are going to deliberately try to memorize this. Examiner can push it to you. I will also, if I'm not asking for too much, because at this level, professional, you are as good as each other. All right, sorry for that. Was MTN slight break, technical glitch. Envies. Tommy, see your face, self. Trust you are good.
I'm fine, sir. Good evening, sir.
Now, maybe they don't want me to say this. If I'm not asking for too much, you can take a company, go and practicalize it. You can take a company of your choice and conduct and do a Z-score test to check if that company is at a risk of corporate failure. You can take Dangote and check Dangote's Z-score. Look at Dangote's Z-score, or pick Nestle Food and look at Nestle Food Z-score. Do the computation. All right, let's move on with the class. All right, I need to try and round up this topic in 30 minutes. I don't know. They are trying to, MTN network is trying to take my class. All right, let's go on. We have discussed the qualitative school. Now, the second school of thought is qualitative corporate failure prediction model. Qualitative corporate failure prediction model. Now, this school of thought argues that companies fail not because of financial problem. The qualitative corporate failure prediction model argues that companies fail not because of corporate failure, not because of financial problems. In their opinion, financial problems are the consequences of corporate failure, not the causes of corporate failure. In the opinion of the qualitative corporate failure prediction model, they believe that company fails not as a result of financial problems. Financial problems are the consequences of corporate failure, not the main cause of corporate failure. They concluded that company fails because of non-financial problems. Non-financial problems such as poor management team, inexperienced managing director. Imagine that. Imagine a company being led by a poor management team. Imagine a company being managed by an inexperienced managing director, what will happen? Where you have autocratic management that do not consult. They don't consult with the staff. They just take decision. Inability to retain key staff, where a company is losing its quality staff. This could give rise to corporate failure. Now, the qualitative corporate failure model is discussed under Argentine model. In other words, a notable model under qualitative corporate failure is what we call Argentine model. The Argentine model is a non-financial model. The Argentine model is a non-financial model that uses three main factors to explain causes of corporate failure. The Argentine model is a non-financial model that uses please just bear with us. It's a technical glitch beyond my control. We are back. Now we have management defects. Defects in management structure. What are these defects? One, let's go to it. Defects. Look at defects. Autocratic managing director is a defect. Or inexperienced managing director is a defect. The Argentine model is saying that where there is management defects or management weakness, the company is bound to fail. These defects include autocratic managing director, inexperienced managing director, failure to separate the role of chairman and chief executive officer. That's a defect. We call it absence of corporate governance. Somebody is combining the role of a chairman with that of the CEO. No check and balances. A passive board of directors. That's management defects. When you have a board of directors that is not active, not very active, not active at all to run the business, why will you be in a board and you cannot participate? You are not active. Company's board is not like a National Assembly, where you can go to National Assembly as a senator and be sleeping. Company's board is a business environment. Lack of management in-depth. Imagine having management team that are not knowledgeable. Inability to respond to change. That's a serious management defect. The inability of a company's management to respond to change in business environments is a major problem. You have a management team that cannot respond to change in the business environment. A weak finance director. Lack of balance in the skills of management team. If you look at management team, you have different professionals. You have accountants, you have IT professional, you might even have engineer, head of property, part of management, engineer, even in a bank. If you look at the management team, the MD might be an accountant or a banker. The finance director must be an accountant. Chief internal auditor or chief inspector must be an accountant. The head of IT, a technical person, must be an IT person. The management team we comprise of different skills. We cannot be all accountant in management team. You are going to have different skills being represented. So please, management defects could give rise to corporate failure. Number 2, accounting defects. Accounting deficiency, such as no budgetary control system in a company. Imagine running a business where you don't have budgetary control. That means you can spend money without budgets. No cash flow planning. No costing system in a company. Imagine running a company and you don't have a costing system. That is accounting defects. That will give rise to corporate failure. Then lastly, mistakes that has been made. We call it error in action. Mistakes happen because there were defects in the first place. Please note, once there's management defects, once there's defects in management team, and there's accounting defects, automatically mistake will arise. They are interconnected. If the management and accounting system is weak, then mistakes are bound to happen. What do we refer to as mistakes or error in action? These are decisions taken by the company's management that could have been avoided. These are actions, business decisions taken by the company's management that could have been avoided. For example, expanding the business too quickly. You are expanding your business too quickly. Please, a small digression, and it's also a learning. In recent time, in the news, Heritage Bank has been flagged as a troubled bank. Heritage Bank is experiencing corporate failure. The major cause of Heritage Bank corporate failure is expanding the business too quickly. They are trying to spread. They are trying to compete with the like of Zenith. You must learn to grow at your own pace, even in business. All right. Number 2, excessive borrowing. A company must know the level of gearing it must take. If you borrow too much, you might put the life of the business at risk. This was the communication the owner of AIT experienced in the past. They have excessive debt. Like I said, at this point, you are going to be looking beyond, particularly if you are doing case studies. You are going to be looking at what happens in your environment. You are as good as a chartered accountant. Then a big project that turns out to be a failure. If a company accepts a big project and that project turns out to be a failure, that could have been avoided where the management is sufficiently skillful. They should be able to know that this business is not good for us. All right, please note, we have discussed corporate failure prediction model under 2 headings. We look at the financial model, the quantitative corporate failure model using Z-score. We also discuss the non-financial model, the qualitative corporate failure model using the Argentine model. Our next discussion, symptoms of corporate failure. What are the signs? As an accountant, what are the things you watch out for that will give you an indication that this company is at a risk of corporate failure? What are the symptoms of corporate failure? 1, qualified audit opinion in a row for many years. Qualified audit opinion. Please, who can tell us what is a qualified audit report? Who can tell the class? What is a qualified audit report? Anybody? Let's feel free to speak. Qualified audit report. Okay, let me ask. What is unqualified audit reports? Normally, if you carry an audit, okay, Robbie, you want to speak?
When an auditor is unsure about certain aspects of the financial statements, maybe something like they're uncertain about.
Fine.
Yes.
Okay, that's fine. That is you make a good attempt. When we say qualified audit reports, let me look at the response. Qualified report, bad reports, Mohammed Jubri, okay? Unqualified report, good reports, okay? At least is able to say, yeah, once you have qualified report, it's a bad report. We are going to finish the class, notwithstanding the temporary glitch. I'm about to explain qualified audit reports. Where the auditor says, we have examined your financial statements and The financial statements presented do not represent a true and fair view of the company's affair. Your financial statements presented to the auditor, do not represent true and fair view. That is a serious issue. That means your financial statements is not representing the true position of your company. Nobody will read that and will not question you. That means the company is window dressing the accounts. So if you have qualified audit reports, it can be an indication that that company is at a risk of corporate failure. High staff turnover. When employees are leaving the company, a max, that could be an indication that the company is not doing well and the company is likely to fail. Low interest cover ratio. That means the company is not making sufficient profits to cover interest payments. Failure to pay the interest can lead to the company collapse. High operational gearing. Operational gearing is calculated as fixed cost divided by total cost. If you have too much fixed cost, when we say fixed cost, that means whether you produce or you don't produce, you must settle fixed cost. The cost will be incurred, whether you produce or you don't produce. Now imagine having higher fixed cost. That means the company is bound to pay to settle that fixed cost. Could be a sign that the company is not doing well. Extended overdraft. Maybe you are supposed to pay overdraft in 1 month. You are now extending it. You can't repay. You are not going to bank to extend it for you. That could be a sign that you are not making enough cash flow. Hence, you cannot repay the overdraft. That could be a sign of corporate failure. Dependent on a single customer. Imagine having just one customer or few customers. You can look for any 5 of these and try to know it. Lastly, avoiding corporate failure. How do we prevent corporate failure? Ten Commandments has been recommended by Rose and Kami. If a company is to avoid corporate failure, what are these commandments? If a company wants to avoid corporate failure, you must pay attention to these 10 commandments as a company. 1, you must have a strategy. You must have a clear strategy. You must define your strategy. How do you get customer and retain your customer? You must have a business strategy in place. If you ask yourself, what is Zenith Bank strategy in getting customer? What is GT Bank strategy in getting customer? Each company must have a unique strategy. If you ask me, Zenith Bank's strength is in marketing. Zenith Bank will go all out to market their customers. They are not wasting. If you ask me, GT Bank's strength is in customer service excellence. A company must have a strategy. Number controls in place. Number 3, the board of directors must participate, meaning that you must have active board of directors. If you are made a director in a company, you can't be passive. You must be an active member. For you to be a director in a company, it's assumed that you have gotten the requisite knowledge and experience for you to be sitting in the board of a company. Then you must be able to contribute to the growth of the company. Number 4, you must avoid a system of one-man rule. As a team lead, you must consult with your team. Number 5, there must be management in depth. Management must be sufficiently knowledgeable. It is very unlikely to put somebody in a management team and that person is not knowledgeable about the business. Number 6, you must keep yourself informed of changes and react to it. You must be able to react to change in business environments. Number 7, the customer is king. Always remember, you are not doing the customer a favor by serving the customer. In fact, the customer is doing you a favor by bringing the business to your company. Always be conscious. If you are dealing with customer, every business has its own customer. Somebody must patronize your business. For example, we are customer to Zoom. We pay subscription for this Zoom. We are the clients now. To us, you are the customers to us. Number 8, do not misuse your computers. Number 9, do not manipulate accounts. To avoid corporate failure, don't manipulate accounts. Whether you find yourself in private sector or you find yourself in government establishment, don't manipulate accounts. Why are we having crisis in the country? To some extent, we have country failure now, where a country cannot consistently meet its objective. That's country failure. Then number 10, organize to meet the need of your employees. these 10 commandments, if it is observed, whether in your personal business or where you find yourself working, the company is likely to survive. That is the end of the first topic, corporate failure. And that will be where we are going to stop tonight. Any question, please? Any question, please? Let's keep it at this tonight. Please challenge yourself. Conduct Z-score on a company. You can share with me the result of your Z-score. Any company of your choice. You can go online, pick a company in Nigeria, download the financial, and conduct a Z-score. Any company of your choice. Any company. We must drive ourselves. All right. Any question, please? Otherwise, we are going to close the class tonight. When we meet next week, we take the second topic, capital reconstruction. All right, I will be checking out of the classroom if there's no question. May God give us a better understanding. Do have a blessed evening. Good night.